So our framework for asset allocation is built around business cycle analysis and trying to understand where economies are in relation to each phase of the business cycle, namely recovery, expansion, um, uh, peak, and recession. And then understanding how different asset classes, different financial assets perform in each phase of the business cycle. Now, historically, business cycles have tended to be, on average, around 5 to 6 years. Now, this cycle that we're in at the moment is a bit longer than normal, and the reason for that is that the downturn that preceded this cycle was very nasty. We all remember how serious the downturn was in 2009, and the worse the accident, the longer the recovery time. So it's now been 10 years since, just over 10 years since the Lehman event. This is a very, very long cycle, and we're not sure exactly how much longer the cycle is going to last. My guess is that we're looking at it ending sometime around 2020. But business cycles are uncertain. You never know exactly how long they're going to be. We're in a period now where we really are approaching the end of the cycle for much of the world. Different countries are at different points in the cycle. The US is probably ahead of anybody else. And what this means is that we're starting to see inflation pressures really now rising quite sharply. Unemployment is either low or falling rapidly across the developed world. In the US and the UK, you've got unemployment rates that are at 50-year lows now. Japan is low. Europe is a little bit high, but also falling. And this means that you've got wage pressures that are rising now. They've been rising for the last year or so. Central banks are well aware of these pressures that are building, and that means that they're either raising interest rates now. In the US, they've been doing that for some time, or indeed in the UK, where we've seen a couple of rises, or Europe and Japan, where the central banks are talking about wanting to end their bond buying programs. And at some point, this is going to mean that as the cost of money rises, you're going to see the demand for financial assets, equities, and the like start to decline. So although we suspect that we're still a little bit far away from the start of the next bear market, you need to start thinking about what will happen when we get the downturn, the economic downturn happening, whether that's going to be a nasty recession or not. And we think that's probably going to be sometime in 2020. So I've set out what we think is happening in terms of the macro backdrop, the fact that we are now in the final stage of the business cycle. What does that mean for asset allocation? Well, this is now the phase where we're starting to see, we're still seeing positive returns from equities, but they are lower than they have been in the last couple of cycles. And that means you have to start moving, or you have to be underweight equities, and probably continuing to move underweight equities ahead of the peak phase of the cycle, which is when you get the bear market, and that's obviously when you get the negative returns. So we've actually been reducing equities for some time now, a year and a half or so. The first reductions of that were moving from being very overweight in relation to strategic asset allocation to being neutral. And around the end of last year, we started to move underweight equities. And we're now around 5 or 6% underweight equities. We're going to continue to move underweight. Not clear exactly how underweight we're going to get by the end of this phase. Sort of depends upon how economies evolve. We never really know how that's going to happen, or indeed when the recession or the downturn is going to hit. I mean, there's a lot of uncertainty around that, but we would probably expect to be around 10 to 15% underweight equities by the end of the cycle, whenever that is. The roadmap that we've set out is one that we've stuck to, this gradual reduction every couple of months or so. We made a reduction just recently at the beginning of October. We made another one at the end of July, and you'll see that we've been reducing equities pretty consistently every couple of months prior to that. So I think we're very much sticking to this clear roadmap that we set out.
Been in the industry for 19 years. In the past 12 years, I've been specialising in fund selection. Worked for different companies, a wealth manager, one of Europe's largest asset managers, an asset manager pegged onto an insurance company, and now an investment boutique. So I've seen kind of the different cultures in the different parts of the business. At Seneca, I joined them this year. I'm going to be looking after the fund selection, particularly developed market equity and developed fixed income, and also the specialist financial portion of our specialist allocation. Okay, with specialist assets, we've been increasing the allocation lately. So as we're late cycle, we've been reducing our exposure to the riskier assets such as equities and allocating to specialist assets. So we're probably around the peak allocation at the moment. Then within that, the portion I'm responsible for will be called specialist financials. What are we looking for in this space? We're looking for investment trusts that are demonstrating bond-like characteristics. So we want to buy cash flows, we want to buy sustainable cash flows, we want to buy them at reasonable valuations. And the types of assets that we're looking for can range massively. So there's things like direct lending, CLOs, music royalties, mortgages, a really broad breadth of products in there. But with the key characteristics we're looking for is the same across all of them.